Seems like everybody out there has been saying that you need to sell bonds. But if you're selling something, there has to be a buyer on the other side. Who might those buyers be? Well, we're going to meet one of them right now. Todd Colvin of Ambrosino Brothers joining us now to talk about why he is bullish on treasuries. And I was sort of joking there as we introduced ourselves, each other off mic. I said, congratulations, you're the one who's been buying it. Hyperbole aside, Todd, what makes you a little more optimistic on treasuries?
Well, there's a couple of reasons here, Brian. First of all, a lot of what we're seeing, not only in the treasury market, but in the equity markets, in some of the commodity markets, and even in currencies, it's all priced for this big boom coming out of whether it's higher rates from the Fed and an exploding economy based on Trump's new policies. And you just have this real big hype behind it. And the treasuries are no different. Treasuries saw yields creep up. We got up to 260 not too long ago. And then we just kind of got stuck at around 2.5%. And I think that right now we're going to start to see some of the reality of that pricing. And we're going to get it this week with the jobs number. We get it with FOMC. And I think that right now, anything that isn't rose-colored could benefit bonds here, and we're already seeing that in equities.
Would it be a short? If you're right, would it be a short-term pop in bonds, or is there? You know, some people say the 30-year secular bull market in bonds is over.
Well, I don't necessarily think this is the beginning or a continuation of a bull market. We're in a different. We're kind of separating ourselves from not only from presidential administrations, but really the world is changing. And I think right now, if you look at where, say, 10-year yields made their run up after the election, we're going to start to get some hard first quarter data. And I don't really think it matters from moment to moment. We want to see real growth. And that's something we saw last week maybe isn't apparent in the U.S. yet when we got that fourth quarter GDP. First quarter GDP doesn't come until April, along with a lot of the bank earnings. So we do have some time between now and then. But if you look at it from a trend point of view, I think the trend of higher yields is going to be over here. We're going to start to build a base at 2.5%. And then I think you might start to see things pop up, which could drive yields lower, not only here in the U.S., but you still have issues going on in Europe. You have key elections in Europe, and you've got several central bank meetings between now and then, which are going to change the look of everything at each meeting.
What's the risk to your thesis?
Well, obviously, I think the risk here is that the economy is booming. A lot of the money comes out of fixed income and goes other places which are far more attractive. And we've seen that already in the equity run-up over the last year and a half. Likewise, we're starting to see some pockets in commodities that were maybe mispriced that we're also seeing bids. But I think right now the real risk isn't that we see yields pop. It's that they slowly and steadily go up. And that's kind of a painful trade to watch. But also, Brian, I think that market volatility, as low as it is kind of mispricing all the potential changes that could be ahead of us. And that's one of the reasons I think the flight to quality bid to bonds is something that we've missed here over the last several months.
All right. Hey, Todd, it was a real pleasure to get your different views. We always welcome them here on Trading Nation. Thanks very much for joining us. Appreciate it.
Thank you, Brian.
Folks, thank you for tuning in. I'm Brian Sullivan. We'll see you next time.